Hello, boys and girls. My name is David. You can call me Don Monroe from the Coastal Traders KE. So today I want to teach you some value. Let me teach you about the strategy I use. So Coastal Traders KE, we are trying to make these videos. We are new to making videos, so maybe we may be making some errors. Please understand us. By time, we'll get the experience, so we can make better videos. But for today, let me teach you about my strategy. Please support us, subscribe to our YouTube channel, like our videos, and even put a comment if maybe a video has you have gained value from any of our videos. So today I want to teach you about the strategy I use here. Before we go there, let me show you about how the market moves, the market structure. So we all know the market moves in two directions, either a bullish or bearish. For anyone who doesn't know the word bullish or bearish, so when the market moves upwards direction is called bullish. When the market moves downward direction is called bearish. So when the market creates higher high, higher low, higher high, higher low, higher high, higher low, that means that the market is moving upward. So by creating this, by breaking this previous high to create new highs, that means that we are moving upward. I think that's the best way to read the market. Let me repeat that again. You see, when the market breaks this low, then creates a high that does not break this previous high, then breaks that low, that means the market is moving downward direction. So it creates a lower low, lower high, lower low, lower high, lower low, lower high, lower low. As you can see, so simple as that, nothing else. When the market moves up, it creates higher highs, higher low, higher high, higher low, higher high, higher low. That's why I've written HH means higher high and HL means higher low. So this confirms the direction of the market. It's so simple as that, okay? So let's continue so I can teach you other things. Let's delete this. So after here, I want to teach you how the market, how you should take entries when the market reverses. So this is something that was a must for me to teach you. Maybe there's someone may be watching this video and does not understand how the market moves. So sorry to those professionals who have watched and said that, oh, you have wasted my time. I know that. Sorry. Let's go now. So when the market moves up, we expect it for it to come down before it creates a new high. It should come down before it creates a new high. Sometimes the market does not come down here for it to create a new high. It may break this high and then come just somewhere here, then create a new high. Understand? So for us to take a trade, we wait for the market to show a pullback so we can take a buy. Because when the market is moving up like this, you cannot take a buy somewhere here. You cannot take a buy here because your stop loss will be big, so your risk to reward ratio will reduce. You cannot take a buy here because you saw it has broken this level. You cannot take a buy here because your risk to reward will be so huge. Not your risk, actually your risk will be so huge. And then when the market comes down for a pullback, you will have very huge drawdowns, which is bad for your mental. So let me show you by example. Let me not just talk. Let's say I took my trade here. My stop loss should be below this point here, and maybe I'm expecting the new high here. You see, the trade even is not 1:1. Like, what will you be doing? What would you be doing? So for you to take a better entry, it's you wait for the pullback like this one. You take your trade. Sorry, that's my wife. right? So you take a trade and then you wait for the market to go up. You see, maybe you wait for it, then put your stop loss below this other low, and then you see, then your market, the market hits to be. Actually, when you take a trade like this, you don't know where the market will go, how high the market can go. So you know what you do, you put your take profit on the high that was created. So you see, you get 1:2.5. That's good. You risk $1,000, you make 2,500. That's good. Okay, so the point I was making is, when you see a leg like this, is created, and then the market retests, oh sorry about that, when you see a leg like this, and then the market retests down here, and then it creates a new leg like that, so you can use your Fibonacci to draw the hold of this leg to where it ended. This is where it ended. I think you can see my fib here. This is all, you see. So here is 1%, here is 100%. So the market moved 100%. Maybe you have seen that the market has created a high here and it's trying to come down here. So you know that this is the end of the leg. Maybe you don't know, the market moves the way it wants. So after creating that high, you know what you do? You come and check this fib and you say, I want the market to retrace at least 50% for me to have buys, so you can have a better entry, a small risk that can give you a huge reward. So when you're above here, and the market is coming down, you can't take here when you haven't hit below this 50. You can't buy here. You have to wait for the market to hit below 50. You can buy from here, but on this zone 50 and below. Above here you can't. So what I wanted to explain here so you see these 2 points here, this is called a premium zone, this below here is called a discount zone. Okay, premium zone, discount zone. So what does the word premium mean? What does the word discount mean? So premium means that when the price is higher than the normal price. Discount means when the price is lower than the normal price. As simple as that. So discount, the price is lower than the normal price. When you go and buy something at the market and someone tells you, oh, this clothes is worth 1,000 but there's a discount of 200, so you'll buy it at 800. You see, so that's the best price for you to buy because it is lower than the normal price. You cannot buy a cloth that is worth 1,000 at the day that you went to the market and you hear people saying, yo, this is 1,200, 1,200. You see, you'll make a loss of 200. So you wait. You can buy it at the day that is being sold at 1,000. Maybe now it's good, but now it won't be better. You want to get a discount. Okay, so that's an example of answer. Let's go back to the market. So the zone below 50 is called discount. The zone above 50 is called premium. So on the premium zone is where we take sales. Here I'll give you an example with a downward trend. When you draw a downward trend like this, you see a downward trend like this. So you come and take your fib and draw the whole of this leg up to this low. So this is your discount zone, this is your premium. What did I say about premium? Premium means that when the price is higher than the normal price. So the day you will find the cloth is being sold at 1,200 and you bought it at a discount zone 800, so you sell the clothes back to them. Maybe they will be buying it at 1,000. That's good, you made a profit of 400. No, actually it's 200. Yeah, you made a profit of 200. But it's better when you sell the clothes back to them at a higher price compared to the normal price. Okay guys, so Here on the discount zone we buy, on the premium zone we sell. I've given you 2 reasons why that it's better to take trades here, because this in a better price and then you get a good risk to reward. Even your stop loss here won't be huge. You may risk a small percentage of your account and still make huge amount of money. Same to this, when it's a downtrend, creating lower lows and lower highs, you wait for the price to come at the premium zone for you to sell at a better price. You wait for the price to come at the discount zone for you to buy at a better price. As simple as that. So that's about the premium and the discount. So next point, I want to teach you about things to look for you to say, let me take a trade. Okay, things to look. So number 1 is liquidity, number 2 is imbalance, number 3 is order block. If you have a book and a pen, you can note that down. Order block, liquidity, and imbalance. So but then you can go to YouTube and watch more video about them. Imbalance and liquidity and order block. I will not explain more about them, but imbalance, you just go and watch on YouTube. It will be much easier, because I just want to make this video to be very short. So let's talk about a leg like this. The price comes down, the price creates some sort of inducement, then we come sweep and then plays again, creates some inducement, sweep, okay, comes again, and maybe it bounce out. So let's start from here, guys. So you can see when the price moves like this, it's better to check an order block. Let's talk about this leg from this point to this point. So when you look at this market, you must know where is your high, where is your low, where is your high, where is your low, where is your high. So this is my low, this is my low before the other low was created, and then this is my high before the other high was created. Okay, this is my other low. The next low that was created after the low was below, this is it. And why this is my low? Because this low is the one that broke above here. I know there's other low here, but this is called the internal liquidity. It doesn't matter a lot, because the market moves from this place to this place. So it means if you put your stop loss, it will be much better for you to put a stop loss below here compared to here. Yeah, you may find a good setup here and put your stop loss, but it is much better for you to put your stop loss below here, because this is where is the beginning of the whole move. So this will be my low and this will be my high. Okay, so this high was broken by this high, and this high was brought above by this low here. So this is my low, this is my low, this is my high. So I won't mark again. So let me explain to you now. Before I take a trade, I usually come, when I see a leg like this, I check for 3 things. One is an order block here, an order block. I'll show you from a chart before we I'll show you from a chart before you end this video. I'll show you from the chart. So this is an order block. You have to see it created below here, and then you should check for an imbalance that was left here. So the market can't move leaving imbalance gaps. It has to come and fill those gaps. So when there's a gap here, and you know the market has to come and fill it, so there's higher chances of the market to come and fill the gap, and then we continue where we're moving. Order block is where there's the money, where the money is put by the market, where the market wants to come and tap so we can move above. Okay, so I want to be so open there and clear here. So when there's imbalance and order block, you expect for the market to come and close the gap of the imbalance and tap order block. About liquidity, this is liquidity. Liquidity is an inducement where the market creates some laws to forge for us retail traders to take buys. When you see there's some traders who took buys immediately the market reached this point and they were taken out, so they like that thing so much to take them out so they can continue to move the market where they want. Same to this. If there's an imbalance here and there's an order block here, there's higher chances that the market will stress up. But before we confirm those two, we will look for the other third thing that is called liquidity. With liquidity, I will teach it on its own, but for now, this is it. This is it. So this is my setup. This is my strategy I use. When the market comes, let's say this is a buy, this is a buy, this is a bullish market. First thing I look is the fib where I should buy at the discount zone. If the market retraces up to this place here, it has not crossed below the 50 fib, does not reach the discount zone, I cannot take buys. I cannot take buys here because I want to put my stop loss on these lows. All of these lows is where I'll be putting my stop loss. So you cannot buy at the premium, you have to buy at the discount. You cannot sell at the discount, you have to sell at the premium. Simple as that. Okay, so that is confirmation number 4. The first confirmation is the market should be should have imbalances, the market should have an order block, and then the market should have liquidity to sweep. You always have to check where there's liquidity, because if you don't see any liquidity, just know your position, where you put your position, that's the liquidity. Liquidity is very important. And then the fourth thing is discount and premium zone. Check discount and premium zone. Okay, so when you look at this setup, let me draw my fib again here, from this place to this place. You see, this is the 50, 0.5, this is the 50%. This is the center of this move, the whole of this move. The market has to stress at least 50 for it to move up. So when it retraces, when the market retraces back and does not close below this 50 here, it's not advisable for you to take a trade, because you won't have a better place to put your stop loss, you won't have a better risk to reward. So it's much better for you to wait to come to this zone, as simple as that. So our next point, let's learn about liquidity. So there's 3 types of liquidity. There's internal liquidity, external liquidity, and engineered liquidity. So there's very many types of liquidity. There's the double top people call liquidity, triple top is called liquidity. Yeah, so it depends with your strategy. Okay, it depends with your strategy. These are the liquidity that I've noticed with my strategy that I've not done. Okay, you can see in external liquidity, internal liquidity, engineered liquidity. Let me explain to you what is internal and external. So when you see a move like this, and then the market creates some sort of these things here, some sort of these things before it creates a new high, then like that. So you see, these are liquidity. This is liquidity that must be swept, liquidity that must be swept. So these are liquidity have been created because you are moving up. So the market has to come and sweep all this liquidity. So this liquidity inside here are called internal range liquidity. External range, this, let me show you. Good. So external. So when you draw higher highs and higher lows, when you draw your higher highs and higher, this will be your low, this is your high, this is your lower low, and this is your higher low, this is your higher high, this is your lower higher low, and this is your high. So this is your HH, HL, HH, HL, HH. So these are external liquidity. So the external liquidity can also be swept, and this internal liquidity can also be swept. So it depends with the structure and how you're trading. Let me explain to you now how are they being swept. So when the market moves up like this, then creates a low, and then the market moves like this. So when the market is tracing back, maybe you have seen your imbalance here and your order block, but there's no liquidity, there's nothing like liquidity on this leg, the whole of this move. This is the best place. I said this is the zone, this is the discount zone where you take buys, but there's no liquidity. There's higher chances that the market will sweep this place here, even if it's a week. So when you don't see liquidity, you don't trade, you just wait for the market. You may sweep this, and then after sweeping it, it pushes up. I don't know if I'm making sense. If there's no liquidity anywhere here, anywhere there's no liquidity, the market may come and sweep this low, sweep it with even a wick or a full candle, anything. I don't know how it will do, but you may sweep it and then move up. So after moving up, the market may come again and see there's no liquidity. It may sweep this and move up. Sometimes it may respect it even if there's no liquidity. But now, will you take a trade that has no liquidity? No, because you'll make many losses for you to come and make a win. So this is external liquidity that has been swept. So that's number one. External liquidity range are the higher highs and the higher lows, the key market structures. They are the ones called external liquidity. So internal liquidity, when the market creates a high, creates a low, it tends to create some internal liquidity, something like this. You see, something like this, then breaks above, and then the market has to come and sweep all this liquidity. Sorry for that. All this for it to make a new high. Sorry for that. Let me draw it below here. So these are called internal liquidity, internal, that are inside this range. This is the low, this is the high. So liquidity that are inside this range are called internal liquidity. External liquidity are liquidity that are outside the range. You see, this is the range from this to this. You see this place, the market went above. If this market could have closed below this low, that's external liquidity. I think that's so simple, guys. So internal liquidity. So for the market to come, when you check for your fib where the market is 50% below for you at the discount zone, and you check for an imbalance below here, when you check for your order block for you to take a buy here, you see, you have to check for liquidity. So when you see this liquidity here, just know your setup is complete. Your setup is complete for you to take a buy. As simple as that. Your setup is complete for you to take a buy. As simple as that. Okay, so what is engineer liquidity? Let me explain to you now. So when the market is moving up, creating higher highs and higher lows, so the market has no liquidity. Do you know what the market does? It comes and creates some sort of this setup, some sort of liquidity itself. So you see liquidity. So some people will see like this and they see the change of character here and they're excited. They wait for the market to retrace a little bit. They take their entry. The market breaks this high a little bit here and then comes and sweep all of them, taps here and then moves now. You see, so this is called the engineer liquidity that is created by the market because there's no liquidity anywhere here to be swept. So the market creates its own liquidity. So you see, so first, do you know what the market does? It creates this so it can put some people here to come and buy. So when they buy now, that's where the market takes their money. So you can see here the market changed character and then even broke above again to show that we are moving up, and then sweeps them out, takes their money. then we buy. So this is called the engineered liquidity. So external, let me explain for the last time. When the market is moving up and has retraced, and you have seen your order block and your imbalance here, and it is on the discount zone, if there's no liquidity anywhere here and the market has reached at this point, just know that you are the liquidity. If you take your buy and put your stop loss below this low here, just know the market can sweep you, then we buy. That's external liquidity. It has to take the external liquidity. So for you here, you have to wait, and then after sweeping this low here, you wait for change of character. But it's not advisable because maybe the market has changed direction, maybe we are moving down, so you don't know. But that's one point I said. The next point is internal liquidity. Before the market comes and do this, before the market comes and break above this high here, it creates some sort of liquidity. It may be a leg, one leg like this, breaks above, and it might come and sweep this liquidity here. This is an internal liquidity created. Sometimes even the market creates a lot of noise. Let me show you. Sometimes the market creates a leg like this, then like this, and then like this, and then the market creates some sort of higher high and higher lows here. You don't know what the market is doing, then moves up. So create another liquidity before it breaks this high. These are all liquidity, and then now it breaks the high. So when you wait for the market to retrace, you just know this is my main low that cannot be broken. So you just wait for the market to come and sweep all of this liquidity here. These are just noise. This is where now retail traders, I don't know which strategy they will be using now. They must be taken out, and their money will be taken. So the market comes and sweep all of them, and then moves up, or it may create another sort of liquidity again here, then come sweep them like that. So that's it. Engineered liquidity, I showed you. Engineered liquidity is whereby there's no liquidity and the market creates liquidity by the leg that is coming down, by the leg that is showing some little retracement before it moves up. It creates its liquidity. So my video, you can see here, is 27 minutes. So I want to show you. Let's go to the chart. So this is Euro GBP. Yeah, let me give you an example of this. So there's a trade here. If you look at this market here from this larger time frame, you see the market is creating lower low, lower high, lower low, lower high, lower low, lower high, lower low. Then here, so from this point, when the market is at the, this is the discount zone. I told you when we are selling, you should never never sell at the discount zone. You wait for the market to retrace at least 50%. When I use my fib, where's my fib? This is the high that was created to this point here. So when you sell, you see where the market is, you sell at that zone. You sell at that zone. For you, you wait for the market to come on. Okay, but when I draw this, I can see this is cannot be my high, because you see the market came up to this place, retraced, is not even 50%. So it's not even 50% of my fib. So this may be my low. Let me draw the fib again. You see, let me explain to you much better. So you see the market came and up to this low. So you see the market came up to this low. It did not retrace even 50. This is my 50. It did not come to the premium zone. So I could have not taken sales here. But you see, I took a trade here and I took a trade here, and then they were both in profit. So if I were to draw this fib, I could have drawn it to this low, because the market has not even retraced to that zone. So you see, so I will wait. If I want to take a trade, I will wait for the market to come. Now it is on the premium zone, but you see, you can't put your stop loss above here. it will be a very huge risk. So you'll wait for the market for it to come somewhere here. Okay, so when it comes here, you see there's liquidity here already being swept, created. There's liquidity here, and then there's an order block somewhere there. You can take your trade and sell. And when the market is here, yes, it's a downtrend. You can risk to take trades in smaller time frame at this point, because you know the market has to retrace. When it sells a lot, the market has to retrace to 50% for you to take. So let me show you here. I saw an opportunity, but I was away from my desktop. I did not take anything. You see here, so the market went above, and then it retraced to this point, and then broke above again. You see, broke above. So I was to take this trade when the market reaches this point, because there's a lot of noise here. You see, this is liquidity. Let me show you. Let's see if the premium zone and the discount zone are on place. You see guys, so let me explain to you. You see, the market was here, created a high here. Even very far, let's use this leg first. Created a high, you see guys, then retraced to our 50. So it created liquidity. This is an internal liquidity that has to be swept. So you could have waited for the market to come and sweep this liquidity, and then there was some noise here, and then my order block could be the whole of this week. So there's different ways of how people draw their order block. It can be a week, it can be the last buying candle or selling candle compared to where you're buying. Maybe you're selling or buying. When you are selling, the last buying candle is what you mark as your liquidity. But when there's indecisive candles like this weak candle that will leave a huge wick, this is where I usually like to draw my come and draw my order block for me to take buys. You see, so immediately the market swept all of these guys here. So there's some people who took trades after seeing the market dropping. They saw this is an order block, they put their stop loss here. But where the market moved is from this position. This is where you should always put your stop loss. Okay, when the market moves below it, it means now we are still going down. So even if someone could have taken it, let me show you by example, not just by talking. If someone saw an order block here and put their trade somewhere here and put their stop loss below here, they could have been still in their trade, but they could have, you see, they could have made money still. Yes, but you see the stop loss now is too big. If I could have waited for it to come and tap this low here, you see guys, sweep all this liquidity. These are just noise. Sweep them, my order block, tap my order block, and then we are moving up. We are making money, guys. You see, as simple as that. So I did not take this trade. I waited for this. This is another strategy similar to this. It's called Quasimodo reversal. I will show you in another video. Let me show you other example. Let me show you these trades I took. So yeah, guys, look, so clean, so clean, so clean, guys. Okay, so when you look at this setup here, so first let me show you these things. Okay, so the market came, created a high, then let's start from here. Let me pull the video down here. So I want to show you the whole structure. The market created a high, created a low, this is the highest point of the lower low. It's called a lower high. So lower low, lower high. Then the market came, created some sort of a low, but it does not break this low. So the main high is this. Okay, the main high is this. Then the market came down to break this low. So this is the main low. The market comes up to create a new high, but Now if I was supposed to take a trade, I will wait for the market to come and sweep this liquidity created here. This liquidity created here. There's an order block here that was never tapped, okay, but the market did not made it to come to this point, so I could not take a trade. In fact, the market came and tapped this order block and sold. You see the market moved down immediately. So if there's no liquidity that was being swept, there's nothing here, you could have not taken this trade, but it moved away. But no, this is not an advisable thing to do, because sometimes you take your trade here, immediately your market goes up and sweeps you. So I waited. So after breaking this other low, so it means this is our main low, this is our main high, it created a new main low. This one here was the low created, then the market retraced back to create liquidity that must be swept. So you see, after that the market break the low here, the main low. So this is the main low. This is now the market is trying to sweep this liquidity. I saw some sort of liquidity here. If I go to 30 minutes, let me show you guys. You see, if I go to 30 minutes, you see it's very clear. This liquidity here was created too. So I waited for the market. I put my orders somewhere there. There's an order block there. Put my orders there, and then the market immediately, this was a very fast move. You see, the market went, there was news, the market went, tapped it, immediately went down. Similarly to this here, let's go back to 1 hour. Similarly to this, so when the market came to this point, retraced back, so now we remain, this has broken this low here, so this comes to be our main low, and this comes to be our main high. Let me delete this, let me delete that so you can see. So you see guys, then the market retraced back. If I draw my fib from this point to this point, the retracement has to be 50%. But you see, there's no liquidity. The market did not create it does not create even the engineered liquidity. There's nothing here. So created a low, created a high, created some sort of low, created a high, created some sort of low, created a high, and then dropped. I could not take this trade because if I was supposed to draw even my order block, imagine the whole of this is an order block. The whole of this week is an order block. So you see, it could have not given me any a good risk to reward. You see, order block, I put my, you see how huge the stop loss already. I will not take that. Those are very many pips. So I did not take that trade, I left it. I came to this other trade. Now this is what I talk, guys. You see this trade, it created the engineered liquidity. I told you about engineered liquidity. So you see the market, there's an order block here, there's imbalance, order block, there's imbalance here, and then there's no liquidity this side. There's no liquidity, it's just a straight. The market jumped down here. So when the market came above here, I did not take any trade. I left for it to play because I don't see any liquidity. But the market changed direction. You see, let's draw. You see, this was the low. You see, that was the low. The market came, broke above, and then changed direction, and then the market reversed back to this point, and then it broke below again to show us that we are moving down. You see, we are moving down. So some people, when they see the change of character like this or this, they will wait for this, they take their trade there, put their TP here, their stop loss above this high, and then guess what, guys? The market did what? Came and swept this high here that was created. Came and swept that high, tapped the order block, and then the market sold down. So I did put my TP on the previous low here. I just wanted to get out because 1:6 is a very huge profit. So you see, I could have held this trade to this low. I could have made huge amount of money. You see, 1:10, but no, I was fine with my 1:6. I was fine with 1:6. You see, so a nice trade. So I told you, when there's no liquidity, the market will create its own engineered liquidity. It has to lie to people that we have changed our character. So after changing character, you see the market retraced back. Some people take buys immediately, see profit, and then their stop loss is taken up. Okay, their money is gone. And then after that, now we go back to the main structure. This is the main high. This is where your stop loss should be above here. This is the main high of the structure. Put your stop loss above there. You know the market cannot cross above. If there's something to sweep here, the market cannot sweep that high too. We swept, we took their money, then the market, and then you see immediately it tapped. After sweeping them, you see the market moved so abruptly. The momentum was high, like you don't even hold a trade for many hours. The momentum was high, the market just gives you money, and then like that. So we wait for another retracement here. The market did not give us a 50% fib retracement. Yeah, so that's it, guys. Our video was 40 minutes. I think you learned something from it. Yeah, thank you, guys.